our February program, Demystifying Financial Stressors for Your Clients with Russ Robertson. Russ is the managing member of CapEx Advisory Group and guides capital project owners through a myriad of financial, environmental, and market risks. The CapEx Advisory Group is a boutique consulting practice dedicated to improving the physical and built environment. The company delivers owner's representation, owner's guidance, and specialized financial services to organizations whose missions change lives. Russ bundles a unique combination of aesthetic, training, and analytical rigor, a pecuniary advantage to any owner's decision-making process. Mr. Robertson is a LEED accredited professional, a former practicing architect, and an MBA recipient from the Wharton School at the University of Pennsylvania. He has designed, built, owned, managed, and financed numerous real estate assets. And with that, we welcome Mr. Robertson. It's all yours.
Well, thank you all so much. It's a pleasure to see many of you. Recognizing that some of you are still joining in, I'm going to kind of dive right into the presentation here. I have a brief PowerPoint presentation that we'll work through. Certainly, I understand that the chat function will be used to gather questions as we roll along. To the extent that I see them as they pop up, I'll be happy to kind of flag a few of them kind of here and there. But just to establish some rapport and kind of give all of us a chance to connect, at least informally somewhat, as we get going here. It is a pleasure to speak to this group. I shared with some of you that I am in fact a recovering architect. I worked as an architect about 15 years ago. And I believe the most wonderful thing about this presentation is that it is actually being delivered not only to architects, but also to builders and to members of the public at large. So welcome to those of you that I've not had the pleasure of meeting before, and it's a pleasure to see those of you that I haven't seen in a while. Demystifying Financial Stressors is, of course, the title here. There's a relatively straightforward agenda that we're going to work through. We'll talk a few opening words. We'll dive into 4 main action items here. We'll look at money. We'll establish some lingo, some common terminology that's recognized in the real estate industry. We'll evaluate a few of the tools that some of your clients use to assess real estate development opportunities. And we'll conclude with some action items that architects and builders can certainly both take in assisting their clients through the maze of real estate challenges and the financing of the various projects that you're all involved in supporting. For those of you who have neither had the pleasure nor the misfortune of ever sitting in on a discussion that I've given, I'm pleased to say that there's always a surprise. Sometimes it's midway through. In this case, we're actually going to start off right away, right out of the gates, with a little bit of a surprise detour from the agenda. We're going to go all the way to the world of the loonie. And if you know what the loonie is, it is, of course, the Canadian dollar. And if you'll humor me here for a moment as we kind of dive in, I'm going to shift from the presentation on the screen here for one moment and go all the way into the brave world of foreign currency trading. Why on earth are we going to foreign currency trading? Well, in effect, what I'm going to try to do over the course of the hour is to simulate a financial panic experienced by your clients as they develop their project. Bear with me as we do this. I'm going to do one thing very quickly at the very beginning of the show here, and then we're going to come back to this from periodic intervals throughout the show. The US Canadian dollar is actively trading on the open marketplace right now for a buy rate of $1.2468.2. So I'm going to fill that in right there at the very beginning, and that's our purchase price at the very beginning of the show. Pause, hold that thought. We'll come back to it, I promise, as time goes on. Back to the presentation. We'll dive in with money. Why is it so hard today to finance capital projects? Well, it's a function of several different challenges. The reality of life is that there is currently a supply-demand imbalance for viable properties. The number of available sites that make economic sense is small relative to the number of individuals, companies, and organizations that are seeking those sites for development purposes. There's a growing use of foreign capital in the United States. Some of you may recognize what is commonly referred to as a 1031 exchange, which in effect is a way of shielding an investor's capital gain tax if in fact they buy another property within a certain time frame. What they are in effect doing is overpaying. They have an incentive kind of built into their math model that allows them to overpay for property, in part because they're trying to dodge a tax hit by simply selling and walking away. Compounding well-intended regulations, rising soft costs, especially financing and specialty features that are now finding their way into buildings, a shrinking pipeline of young trade workers. You may or may not know that for the first time in American history, the average age of a construction worker is higher than it's ever been, the highest of all time today. You could argue that recent immigration policy has had a dampening effect on labor markets. Whether you believe that or not is kind of entirely speculation on your part, but nevertheless, it's a real issue. COVID impacts, not just on material costs, lumber especially for the last 6 to 8 months, but also impacts on rent rates.
Sorry.
Testing. Yeah, we're good. Okay. Not just on rent rates for office, but also retail and to some degree apartments. All of these things have a compounding effect that have exacerbated the gap between total cost of project and completed value. How big is the problem? Well, it kind of depends on where you are. This varies a little bit by project type. It varies a little bit by marketplace. A recent example that we are able to share with you, this is actually a real example from a real project. A total project cost, all inclusive of everything, for one of our recent projects was $10.5 million. Its appraised value was 1.5. Imagine if it cost Apple $10,000 to build every single iPhone it sold. Or imagine that it cost Tesla $400,000 to make every Model 3 that it sells. The reality of life is that for a while, it actually did cost Tesla $400,000 to build a Model 3, in part because they hadn't scaled up yet for production, in part because they hadn't really perfected their technologies. But unlike automobiles and cell phones, buildings are almost always customized. They're almost always unique. They're almost always like snowflakes, kind of discrete from one to the next to the next. And there's certainly, of course, technology and standardization that does occur within the building industry, but certainly not on the scale of replication of Teslas and iPhones. So backing up just 1 second, the wide gap that you see here is a little bit of an anomaly. There are certainly others that are less severe, but nevertheless, the industry is observing quite a shift in gap between total project cost and completed value. Let's talk money for a minute. There are 2 broad client types that each of you serve, both builders and architects combined. And for those of you that are listening in from sort of the general populace, you might represent one of these 2 types of clients or organizations, for-profit clients. And broadly, I'm going to gang together nonprofits, governments, and institutions in one category. And briefly, we can discuss their broad monetary objectives. On the left side, profit maximization is the name of the game for-profit developers. There's a heavy dependency on what some people would say the 3 best letters in the English language, OPM, other people's money, the utilization of lots and lots and lots of other people's money, in part to shield them from their own financial risk. And we'll learn a little bit more about that as the conversation goes on. You can characterize the group on the left as the thrill of the chase. On the right side, loss minimization seems to be more the norm. And what I mean by loss minimization is a nonprofit organization, for instance, often takes on a real estate capital project in part to generate economic activities that then support their parent organization, which in and of itself may be losing money. We see this time and time again. An organization like a mission-based nonprofit group will endeavor to complete, design, execute, and construct a capital project to add to their mission in a way that generates revenue for the organization to minimize their current operating losses. Nonprofits, governments, and institutions all have a habit of trying to maximize scarce resources, and fundamentally the primary goal is to address mission or social issues. Armed with that information, I'd like you to think just 30 seconds or so about the individual organizations that you know that fall into either of these 2 broad categories. And more importantly, think about the personalities of each of those organizations, just for 5 seconds. And if you included adjectives like these in your mind, you're not wrong. On the left side, For-profit developers, clients tend to be sort of aggressive, driven by ego, always in a rush, motivated by individual motivation or ambition, I'm sorry, prone to litigation. On the right side, nonprofits, governments, institutions tend to be a little bit more conservative, a little bit more driven by data and outcomes, slower, they contemplate more. They're motivated by consensus more than they are by individual ambitions. They seek resolution to conflict. If you extend this even further beyond the text on the screen here and look at the individuals that you know that work in these different organizations, you could draw some conclusions about who they are as individuals as well. And stereotyping is always dangerous, but nevertheless, it can be used from time to time. Left side, former contact sport athletes in high school. Left side, prone to traffic tickets. Right side, former glee club members in high school. Good driver discounts. Lingo. Before we go there, I just want to take a quick peek at one thing. Let's go back. Let's leave this just for a minute. And for those of you who are kind of late joining us, we have a side activity kind of brewing off in the distance here, trying to simulate a financial panic, which we'll learn more about as the conversation goes on. And in effect, what we tried to do here is to buy the Canadian dollar. When we first started, the Canadian dollar was trading for 1.24682. On the sell side, right this moment in time, it's fluctuating a little bit, but 1.24659 looks like a pretty good number. So I'm going to hold on to that one for just a second. I'm going to start to unhide a few things just so that we can have some conversation around pieces that are about to come up next in our presentation. First and foremost is the notion of leverage. We're going to talk a lot about leverage as the conversation goes on. One of the unique features about investing in foreign currency is this idea that you can lever up your investment as 100 to 1, an absolutely staggering amount of leverage. What does that mean in plain English? Well, if at the beginning of this conversation, I had $100,000 in a bank account that I wanted to lever up to buy foreign currency at a rate of 100 to 1, in effect, I could buy the equivalent of $10 million of Canadian currency. I would be buying 8 million units of currency. By contrast, I'm going to unhide these cells here to show that the alternative would be to use no leverage whatsoever, to use simply my $100,000 amount with no leverage and only buy $100,000 worth of foreign currency. We'll come back to that again in a minute. Lingo. Here it is, leverage. Leverage is one of the most fundamental concepts in financial engineering. It's one of the most used techniques by your clients to grow their capital, to build wealth. What does it mean in plain English? Well, it's the use of debt to enhance an equity return. It's really what it boils down to. More debt, more leverage. You just saw an illustration of 100 to 1 versus 1 to 1 on our little spreadsheet. And to kind of put that in more simplistic terms, using really, really basic numbers, suppose we have a pre-construction budget of $10 million, you pick the number. And let's say hypothetically, we were going to fund that in two parts: equity to the tune of $2, debt in the form of a mortgage or a loan to the tune of $8. We've invested a total of $10 in our project. And if at the end, by the time everything is said and done, that $10 project is now worth $11, and assuming for a moment that the debt service remains the same, in reality, it's paid down and then there's interest payments and there's some other little twists and turns. But by and large, what has happened is that that $2 cash equity investment made by your client, whether they are for-profit or nonprofit, has grown to $3, a 50% return from 2 to 3. In an unlevered model, our client used all equity to finance this $10 transaction. They have no loan. Their $10 is now worth 11 because in effect, the whole project moved from 10 to 11. So on this side, the unlevered return for this scenario is a 10% return, the growth from 10 to 11. There's a hidden metric in here. The unlevered return amount, in this case, $1, could be $1 million, whatever it is, has to be higher than the total interest earned by a lender. Otherwise, a mortgage actually hurts your client. You don't have to really know what that means yet. It's not really that important, but it is true that if this $1 gained is not higher than the interest paid to your lender or a client's lender, having a loan hurts your client. Slope of the line matters. Go all the way back to high school algebra class here. And I promise we're not going to dig into the details too much, but nevertheless, the good old formula y equals mx plus b applies here. In this case, let's stick with our levered return for a moment. We've turned $2 into $3 over a time period of 1. We'll call it 1 year. You could call it 1 month. It kind of doesn't really matter. But nevertheless, in one time unit, we've taken a $2 equity investment in a project and turned it into $3. The slope of that line is in effect 1 unit of time, $1 of climb. The old y equals mx plus b. B is, of course, the y-intercept at time 0 is 2. The formula for this line, y equals x plus 2. That's a rather spectacular rate of return. By contrast, if it takes 4 time periods for your client to earn that same $1, their internal rate of return, as calculated by Excel or any other software that lets you do this, has cut almost, by a fifth. The slope of the line is a quarter of its original value. Now we're dealing with a climb of 1 and a run of 4. So 1 over 4 becomes the new formula of the line. I'll take a quick tour back just to share a few more things on this foreign currency idea to illustrate a few little subtle twists here. I'm going to put in now the sell value of 24650. That has dropped a little bit more. I want to unhide a few more cells. Now we're starting to get into the math of this a little bit. We put our $100,000 on the table in much the same way that your clients begin to invest capital in their projects at the beginning of the planning stage, and some part of the market around them begins to have an influence on their outcome. Our $100,000 was levered up with $9.9 million of loan, and in effect, we bought $10 million of Canadian currency about 15 minutes ago. If we were to sell it right this moment in time, we would get $9.997 million back. We'd have to pay off the $9.9 million loan, and we'd be left with $97,000. In 15 minutes, we've had a 2.57% loss of our capital. Is anybody getting a little bit nervous? If you're a client, do you start thinking about calling your architect and making changes if some part of what's happening in the market around you suggests that your equity outcome is not going to be favorable? Maybe, maybe not. It's kind of hard to tell. On the unlevered side, a more conservative client of yours who didn't use as much aggressive leverage, put in $100,000 at the beginning of the 8:30 slot, has a value now today, right this moment in time, worth $99,974. They've lost $26 over the 15 minutes or so for a 0.03% loss. So they're not as nervous as the client who has already lost 2.5% in 15 minutes. I'll come back to this. Next up, sensitivity analysis. Sensitivity analysis, as the graphic suggests, is that there are often little tiny things in life that can bring down great big things, that can have a big impact on the outcome of something large. A change in one variable has a disproportionate impact on economic outcome. What happens, and several of you wrestle with these kinds of things every day in the course of your business. What happens if the cost of interior signage doubles on a job? Well, interior signage might only be 0.001% of the overall project cost. And if that becomes 0.002, is your client really harmed? Maybe, maybe not. But what happens if the cost of steel and lumber changes, increases specifically, or decreases? What happens if rent rates are not as high as expected, or that vacancy is higher than expected? By how much does it matter? At what point does it begin to matter? What happens if vacancy climbs from 10% to 11%? What happens if it climbs from 10 to 20? What happens if leverage is changed? Is your client impacted if the amount of debt capital they're using, or the amount of subsidy, which we'll talk about in a minute, is changed? Do they get hurt if that happens? Are they helped if that happens? What happens if the schedule is extended? And I think we just saw an illustration of what happens when the schedule is extended. The internal rate of return, the rate at which your client is earning money, begins to fall. And this is a key piece in why architects are often asked to hurry up and builders are often asked to hurry up. It sounds very basic, but now you can kind of see through the math formulas here why this actually matters. And obviously the fundamental kind of germane question here is which variables have the greatest and least impact on an IRR? And how do you know? Tools. Let's take a quick peek at tools, and we'll come back to the foreign currency example in a few more minutes here. The basics of a capital stack. Capital stack is kind of the top tool used by your clients to understand the composition of all the funds they need to support the development of their capital project. And in the initial iteration or drawing here, I'm only going to show two portions, the base and the midsection, debt and equity. Traditionally, these are kind of recognized as the component pieces of a capital stack. Within each, there are certainly subsets, preferred equity versus whatever, mezzanine debt versus conventional mortgage debt. But broadly speaking, debt is on the bottom of the stack, primarily because it is the money that must be repaid, regardless of what happens. Equity, the next stack, the next level on the stack, the next pancake, is in effect your sponsor's at-risk capital. And this is true whether you're talking about nonprofits, governments, institutions, or for-profit entities. At some level, many of your clients are required to put some amount of their own resources at risk in the development of a capital project. Today, there's a third bubble. And many of you know this, particularly those of you who work in not necessarily top tier markets, but sort of secondary and tertiary tier markets where the cost of construction is significantly lower or higher, I'm sorry, than end property values. Subsidies have grown significantly, and the use of subsidies have grown significantly in recent years. Subsidies include tax credits, grants, other forms of philanthropy, impact investment dollars, in effect, dollars that don't need any repayment at all. They're not expecting any kind of a return from the project. And while this looks like a nice little tidy snowman, it doesn't always look like a nice tidy snowman. Small head, mid-size, midsection, sizable base. As we go into this a little bit more, we'll start to see that there are exceptions to the way the snowman comes together. So how does your client make money? Well, this outer box here can be described as the total project cost, made up of the three primary sources of capital, the debt, the equity, and the subsidy. As time goes on, ideally what happens is that the future value, this now blue box, is greater than or at least equal to the initial project cost. And if you remember something just mentioned a minute ago, that subsidy burns off, meaning that it's not required to be repaid in any way, debt balances are paid down, much like you pay off a mortgage on a house over time. The difference between the now smaller debt and the top of the future value box becomes your client's residual equity. Their equity grew, therefore they made money. Now, clients take fees and they do other things to make money as well, but by and large, this is how your clients grow their equity in a capital project. So that all sounds fairly straightforward. What can go wrong? Well, lots of things can go wrong. Suppose the future value of that project ends up being less than the project cost, as we saw at the very beginning. This is unfortunately kind of the new reality that we're living in. In this case, debt balance is still paid down as it was in the prior screen, but because the future value of the project shrank 5 to 10 years later or whenever it is, remember the subsidy burns off as well, your client's equity shrinks. They're losing money. Can it get worse than that? Remember 2008 and 9? In 2008 and 9, the future value or the projected value of various properties was so low that it was actually below the value of whatever debt was outstanding at the time. And the complication for banks here was that many of the notes that originated, and by notes I mean loans, that originated in 2001, 2, 3, 4 perhaps, had what were then known and still are known now as balloon payments, meaning that for 5 years, the borrower was entitled to make principal and interest payments. But at the end of that time frame, the buyer was then obligated to refinance. And the challenge was that refinancing meant finding appraisals that believed that projects were worth more than the outstanding loan balances. And those appraisals could not be had because future project values or property values were less than the outstanding debt balances that were due. So not only did the subsidy disappear, now the equity is gone. The client has literally nothing left. If there were personal guarantees involved in the debt financing, your client now has to contribute capital to get their way out of the jam, meaning they have to close the gap between the remaining debt balance due and the future value of the project. They have to pay to get out of the project. And banks, unfortunately, took control of a lot of properties and played landlord, whether they wanted to or not. And this became kind of the underlying mechanism that really reinforced the 2008-2009 financial crisis. Before we go here, I just want to take a quick peek. Remember, we're simulating a financial panic on this other screen here. What has happened to the US Canadian dollar here since we last spoke? Well, we've had some good news. 668, I think, is where we are now. Let's see what's happening now. All right, well, we're doing okay. We're only losing 1%. I want to unhide a few more cells here to kind of layer in some of the complexity as we're getting into it a little bit further. It's been about 25 minutes since we bought our Canadian dollars. There are 58 25-minute increments in a day. And if you're really good at math, at the rate that we're at right now, by the end of the day today, or I should say by 8:30 tomorrow morning, our $100,000 investment will only be worth $52,000. We will have lost half of our money in one day based on the rate of collapse that is occurring right now based on market rates for the US Canadian dollar. On the flip side, the unlevered version of this investor who put in $100,000 and sold at this price point 25 minutes later, at the end of today, or the end of 24 hours, 8:30 tomorrow morning, their value is projected to be about $99,355 or thereabout. Who's more comfortable right now? This column or this column? Well, that's pretty obvious. Excel can go a step further or two and project what this value would be worth at the end of the week, at the end of the month, and at the end of the year. We're going to lose all of our money in a week if we keep this up. And if you're a client that's highly leveraged and you're experiencing market fluctuations or information that's changing how you think about your project in ways that aren't exactly favorable, you're going to call your architect or your builder almost every day and ask for help, changes, tweaks, adjustments, etc. We'll come back to this and see how we do by the time it's all said and done. Within for-profits, there are sort of two basic strategies for financing capital projects. No subsidy, which we've kind of already addressed, and then some amount of subsidy. In second-tier markets, third-tier markets, heavy dependency on subsidies is the norm for speculative for-profit developers. And you can think about all the developers you know that have ever financed their capital projects this way. The name of the game for for-profit developers is to take on as much debt as they possibly can and support it with rent streams, rent income from the development of apartments, offices, retail, et cetera, you name it. And to the extent that they can attract subsidy dollars to their project, either because it's in an enterprise zone or some kind of property relief zone or whatever the case may be, they're going to try to insert as much subsidy as they can and minimize, perhaps even evaporate their cash equity exposure. If this developer on the right side can attract enough subsidy and enough debt dollars that they don't have to put in a single cent, in effect, what they've bought is a lottery ticket. They've basically acquired a free project to which they have no claim economically. They've invested no capital. Who's riskier, A or B? Answer's pretty obvious. B can be a little bit more vulnerable. And unfortunately, in Baltimore in particular, you can probably name 3 or 4 or 5 developers who 10, 15 years ago adopted this model and, almost to their fault. And sadly, 2, 3, or 4 of them are no longer in the phone book. They're no longer practicing. Whereas on the left side, these might be more like private or public REITs, larger organizations that can put a lot more equity at stake, that can think a little bit more freely about the pressures of market variations as they move through their planning stages. Because if this shrinks 10% or 20% during planning stages, they're okay. If this box shrinks 10% or so during the planning stages, the equity here is evaporated, it's gone. Which for-profit is more likely to be erratic? Obviously, I think the answer is B. For nonprofits, there's a similar experience. There are 2 broad types. Some nonprofits engage in lots of subsidy to support their projects with a minimal amount of equity and a modest amount of debt. And the reason for the modest amount of debt is that most nonprofit-led projects or government-led projects or institution-led projects generally don't generate a lot of income. They're not in the business of maximizing apartment rent rates or office rent rates, for instance. So the amount of debt used by a nonprofit is generally smaller, not always, but generally. And the amount of equity on the left side for a cash-strapped or a cash-constrained nonprofit is often very small. And the cash-strapped, cash-constrained nonprofits that you know are in the business of attracting as much subsidy dollar as they can possibly find. Donations, grants, impact funds, tax credits that they can sell, you name it. On the right side, these are more of what I would consider to be kind of the anchor institution scale organizations that might have significant equity resources to work with. So their snowman looks significantly different. They might attract a few subsidy dollars at the top, maybe not a lot. They might use roughly the same amount of debt as compared to their cash-strapped nonprofit partners on the left. But because they can infuse significant equity dollars in the middle of their stack, who's more likely to move slowly in their planning process? Well, kind of this group, because they feel as though they have the flexibility to move slowly. They're made up of lots of internal stakeholders and they need to make a lot of internal decisions. So it is likely to be true that clients that are capitalized in a snowman that resembles option B are generally the slower moving clients that you know of. There's a bonus point in here. There's a hidden downside. Clients that act like this, that are financed this way, often think slowly because their financing allows them to do so, but they actually struggle to forecast the end needs of their constituents because there's a long lag between the moment of conception of their project and the day the project is delivered. And in some respects, that can be expensive. That has a hidden cost. A building that fails to fully satisfy its mission is a rather expensive mistake, as kind of the red text here shows. And many of you have seen this play out in a number of different ways, whether it's a completed project that needs to then be reversed and undone or redone, or countless iterations of design rethink for what seems like years on end. Either of those outcomes are extremely expensive for the organizations that are financed in this way. There's a comment I see in the notes, but option A often takes a lot of time to get committed subsidies. And that's absolutely correct. That's the other side of this, is that A can be problematic for timing reasons as well, for certain. Thank you. Other terms, let's dive in here. Let's take a look. We've already learned a little bit about how subsidies, equity, and debt come together to make up a total project cost. So this is a hypothetical scenario here, a $700,000 project made up of 50 in subsidy, 150 in equity, and 500 in debt. Operating revenue. All rent received. These are rents collected. Sometimes this is expressed as gross potential rent minus vacancies and concessions and other things. We're going to call it $100,000 for the sake of our argument here, letter E. Operating expenses are all the expenses associated with operating a building, taxes, insurance, repairs and maintenance, kind of all the above, property management to the extent you have it. In our hypothetical example, we're going to call that $600,000. Net operating income, the NOI, is one of the most important measures in the calculation of a real estate project. Again, whether this is a for-profit or a nonprofit that has income and expense, the net operating income is one of the most important pieces. It's the money that's left over after subtracting the operating expense from the operating revenue. And then last on this sheet is the debt service. Using a roughly 5% number on the $500,000, we're putting in here $25,000 in debt service. Fast forward one slide. Free cash flow is the next item up. Free cash flow is the difference between the net operating income and the debt service. Pretty straightforward. This is what's left over after everything has been paid. Subtracting the debt service from the net operating income. Banks, lenders, care a lot about what's known as the DSCR, the debt service coverage ratio here, is a measure, a safety factor in effect, looking at by how much a client covers the debt service. And you can think about this in design in the realm of structural engineering for beam design. Let's just say a beam can hold a certain amount, we know that, but structural engineers use safety factors above that to make sure that hypothetically something goes wrong, that beam is not designed for its actual capacity, it's designed for something higher than its actual capacity. And in effect, banks and lending institutions want to know that about how their clients' financials are performing. They're looking to a debt service coverage ratio for a measure on that. Most lenders today look for somewhere around 1.25 or so times debt service. And the simple calculation here is it's 40,000 divided by negative 25,000 or negative. So 40 divided by 25,000 is 1.6. And the other piece here that's really germane mostly to your sponsor client is the cash on cash, which is looking at this $15,000 number here, the free cash flow, and dividing it by the 150,000 that they were required to put in at the beginning. So in this case, the cash on cash is 10%. And the last feature that shows up on this chart is what's known as a cap rate or a capitalization rate. I'm going to loosely describe this as the bare minimum equity needed by a project like this one on an annualized basis, the bare minimum yield, the bare minimum cash on cash. There's a lot to be said about cap rates, and they're extremely important in determining the value of a property, in part because they are actually used to forecast future value of property. So there's 2 bonus points in here. The first is that cap rates are market driven. High cap rates are usually observed on risky assets in second and third tier markets. Cap rates as high as 10 or 12 or sometimes even 15% would be observed, let's say in Des Moines, Iowa, for a custom craft mom and pop food operation store. Whereas in Washington, DC, you might see a very low cap rate on a safe asset, office property being leased to the United States federal government, for instance. You might see a cap rate there as low as 4 or 5%, very, very low. The second bonus point that's hidden in here, like the issue above with the unlevered return, cap rates, in this case 8% for our model, are almost always, but not always, higher than the interest rate on the mortgage. Why is that? Well, if the equity is earning less than the mortgage, why have any equity? So setting that aside, the math works like this. You take the net operating income and you divide it by 0.08 and you get $500,000. There is a projected value of this project of 500. Well, we have a problem. 500,000 of projected value is less than the $700,000 of projected cost. And herein lies the rub. So what are the solutions? There are at least 3 options to choose from. There are several more. The first is that you really actually have to back subsidy out of your calculation up at the top, because the $50,000 that burns off, that's not actually seeking a repayment of any kind, is really not part of the calculation. And by backing it out and looking at the at-risk capital, both the debt and the equity, the total hurdle that we're really trying to clear is actually 650, not 700,000. That doesn't quite get us all the way there. Option 2 is to grow the subsidy. How do architects and builders help their clients grow the subsidy? Well, it begins with exercising your aesthetic and execution skills by selling your client's vision to their funders. And you get these requests, whether you know where they're coming from or not, all the time. The deliverables of glossy, sassy renderings that communicate the grandeur and success of the project that your client is working on is being used by your clients to go out to the marketplace and solicit additional subsidy dollars. In effect, that's kind of the gist. So if you can help your client grow their subsidy through your actions, the client can then take that extra $100,000 and assign it to either one of 2 things, either the equity they have to put in or the debt service that they're trying to seek. In this example, I've applied it to the loan. So the $500,000 loan is shrunk by $100,000 because the subsidy grew by $100,000. And that has some other benefits. The debt service now falls from 25,000 down to 20. The free cash flow now grows from 15 to 20. So our metrics down here are enhanced. The debt service coverage ratio now climbs from 1.6 to 2.0. And the cash on cash grows from 10 to 13%. This developer that's been successful raising additional subsidy has benefited from the combined efforts of the client, the builder, and the architect to go out into the marketplace and raise additional subsidy dollars. But we didn't really do anything to improve the projected value of the project. And the reason for that is we didn't really attack the driving force, the net operating income. So our third option here is to grow revenue, or you could say shrink expenses, or you could say shrink project costs. But on that last one, shrinking project costs, I think we all know we've done everything we can as an industry to value engineer just about every project to death. And where there may be some creative thinking left for architects and builders is to help our clients recognize opportunities to make just subtle tweaks to revenue. In this case, taking 100,000 of revenue up to 105, absent any other change, grows the net operating income from 40 to 45. And that now suddenly has a big impact. It carries the project value up by a significant amount. A relatively small adjustment here translated into a relatively significant adjustment here. And now we have a projected value of 562 that is in fact higher than the net project cost backing out the subsidy dollars. And in effect, we've kind of done it. There's a bonus point to remember here. Obviously, this is a classic example of sensitivity analysis. A 5% increase in the operating revenue translated into a 12.5% increase in projected value. And in effect, this is a form of leverage. We're moving one little tiny thing to accomplish some bigger adjustment somewhere else down the chain. Sources and uses and other basics. I'm going to kind of fly through these and then we'll wrap up. Sources and uses is one of the most important tools that your clients use in developing and assessing a capital project. This has extensions into cash flow statements and pro formas, and we'll see in a minute how we as a company like to use our sources and uses declaration or statement as the basis for cash flow and pro forma calculations. But 4 main topics have to be established front and center. Sources have to equal uses. If you don't have enough money to build what you want to build, you don't have a project. It's that simple. Time matters. And in this case, what I'm talking about is not the time that an investment return comes back, but the timing of the individual source dollars as they arrive within a capital project. We'll talk a little bit about what can only be abbreviated as dollar in, dollar out. And we'll talk a little bit about restricted money or restricted funds. So right out of the gates, here's another really simple example, and don't feel like you have to track every number on the page. It's not that important, but the basics here are that sources of 4 million, different example here, match the uses of 4 million. Our uses are made up of about 300 in acquisition, 3-ish million in construction, and $600,000 or $700,000 in soft costs. The uses are made up of a lot of subsidy, lots of grants, lots of tax credit, a little bit of cash, a modest sized loan. And if you remember back to those bubble diagrams, in fact, this kind of resembles this nonprofit group or maybe a for-profit group that's looking for a lot of subsidy to support a project, perhaps because they only have a minimal amount of equity, and perhaps because the operating performance of this project can't really substantiate much in the way of a loan. So nevertheless, that's what this sources and uses stack suggests that our client might look like. Let's introduce time. So now we're talking about time matters. And here I'm just introducing 5 or 6 sort of random time increments. You could call these years, you could call them months. It kind of doesn't really matter. The idea conceptually is that not all of these dollars, these source dollars, arrive on the same day. Some of them arrive later, some of them arrive sooner. And not all of our uses are spent at one time. They're spent kind of gradually over time. This $300,000 acquisition, for instance, might be spread across 2 time frames, 250 here and 50 there. Our $750,000 tax credit might not come until time number 3. We don't really know. And now when you sort of look down each one of these stacks, we've got 200,000 of source capital here. We're trying to finance $50,000 of uses here. We've got a surplus of $150,000. That looks pretty good. We're okay. But in the next time slot, we've only taken in $350,000 in source money, $250,000 in grants, $100,000 in the sponsor's cash or the developer's cash. But now we're trying to buy that property. We're trying to pay soft costs for architects, maybe get through some legal costs associated with the purchase transaction. We're trying to spend $420,000, but we only have $350 to work with, $350,000 to work with. So are we in a cash deficit? Is this an indication that your client's going to run out of money mid-project? Well, not necessarily, because dollar in, dollar out matters. We like to put in a beginning cash balance, use, and then end of cash balance with every one of these capital or sources and uses, I'm sorry. And this is where source use becomes more like cash flow. Starting out down here at the bottom, we're starting with $0. We have none. We're going to take in 200. We're going to spend 50. We're going to have a net of 150. That 150 fills in here, and our ending cash balance for time 1 is 150. That 150 right here carries over and becomes the starting cash balance or the beginning cash balance for time 2. In time 2, we take on an extra 350, but we're spending 420 for a net of 70. But because we had 150 to start with, we still have $80,000 in the bank. Okay. If any point along this line is negative or below 0, your client has experienced a cash shortage and they can't pay their bills. And many of you have found yourselves in the predicament of getting that phone call from someone that says, I'm going to need you to wait on your invoice. And it's because, for better or worse, something like this has happened in the background and they've bottomed out somewhere along the way. Restricted money. What happens if a grant is tied to a specific action that must happen first in the sequence? Well, this is a relatively easy thing for your clients to do, and the most sophisticated of them know that often this means the insertion of pledge-based loans that are not necessarily real estate loans. So conventionally, the way to think about this $1.5 million is that it's actually a mortgage, which is tied to the real estate as collateral. But there are lenders out there that specialize in recognizing that future funds needed to cover certain actions can be advanced to an owner and delivered in the form of what are commonly referred to as pledge-based loans or pledge-based financing pieces. We'll wrap up with some action items, and then we'll go back and check on our financing of our foreign currency here. I'm not going to do this David Letterman style in the interest of time, but there are a top 10 list here for architects and builders, and I will kind of annotate a few of these as we go along. So humor me here. First and foremost, I think it really is incumbent upon all of you, and even those of you who are not in either the design or construction budget, to understand where your client fits within the various options that have been kind of laid out in this presentation. What does their financing structure generally look like? Are they for-profit? Are they nonprofit? What are their motivations? And then as an architect and a builder, adjust your tempo to match your client type. And this is a little bit of a subtle comment here. Some of you I know work inside of firms that serve both for-profits and nonprofits and institutions and governments. And you may recognize that your colleagues, your coworkers that are on one side of that bridge as compared to the other operate differently. They attend meetings differently. They're under different kinds of time pressures. It's because they've had to adjust the tempo, the pace at which they work to match the financing needs of their clients. And for those of you architects, especially who work with for-profit developers, what this really means in plain English is your favorite sub-consultants, your favorite mechanical, electrical, plumbing engineers, your favorite structural engineers are those that can respond as quickly as you can to the needs of your clients while they're moving rapidly through this rapid fire exchange under pressure from all the different market forces that are impacting their perceived outcome. And if you begin to realize that mechanical design firm ABC is slower than mechanical design company DEF, you're going to work with DEF because you kind of have to. Whereas on the nonprofit side, if ABC is the better firm strategically because they know more about, I don't pick on something, air exchanges in hospital ORs, for instance, even though they're slower and maybe even more expensive than firm DEF, you're going to pick a different set of subcontracting teams or subconsultant teams to reflect this urgency to adjust your tempo to match your clients. Number 3, address the long lag between conception and delivery, i.e. timeless design. And thanks to the Zigger-Sneed team for pointing out that really in both scenarios under the nonprofit world, either the nonprofit that needs a lot of subsidy up front or the nonprofit that has a lot of cash equity and can think slowly in their process. The solution to this, I believe, on the design side is timeless design. Solutions that don't necessarily fall victim to changing whims and sort of fads, if you will. Timeless design matters. It gives your client the edge in the sense that their lag doesn't necessarily hurt them as much as it could. Emphasize your pre-con services. This note is headed probably more to the builders on the call than to the architects, but really but both, and especially schedule and cost forecasting. Related, communicate your anticipated cost and schedule impacts before they occur. Use your crystal ball. You have it, you know it, use it. Exercise your aesthetic and execution skills to help sell your client's story. We've touched on this just a little while ago. There is real value that you can offer to your clients by helping them achieve their goals for attracting subsidy and even debt dollars to that extent. Conduct sensitivity analyses to evaluate the impact of various configurations. Be creative with how you do this. Come up with metrics that are kind of unique and never before used to look at shade cost per person to determine whether that $1 million shade structure in the public park is as wise an investment as 30 Williams-Sonoma tables with umbrellas on them. What is the shade cost per person of that $1 million structure? And if it seems out of whack and doesn't align with your client's interest, adjust your path. Be aware of the need to understand the sensitivity of what a few dollars mean kind of here and there. I'm going to get in trouble for the, whatever it is, 8th one here, because I will find myself on the opposite side of a negotiating table from some of you at some point by putting this out there, but I'm going to say it anyway. Ask to view your client's financials. Ask to see proof of funding at various points in design and construction. The more you know about how well capitalized or not your clients are, the more you can protect yourselves from the eventualities of uncertainty there. Protect yourself during highly leveraged transactions, highly leveraged projects. Seek retainers, have those retainers held in escrow so that if and as your clients do occasionally bottom out and have stalls or moments where they can't pay your bills, you've got some recourse or some tool set up in advance to help solve your problem. Don't let your client's cash flow problem be your problem. And last but not least, this is a really important one, especially as we make our way out of a pandemic and enter a period where potentially the marketplace is about to change in positive ways. Don't get caught up in the hype. Avoid the hype. Do not trade your services for equity in any project, even if you think you really understand the risks. Unfortunately, the road, even in Baltimore, is littered with architectural firms that got into the habit of trading services for equity in projects in 2002, 3, 4, 5, 6. And then in 7 and 8, the bottom fell out and firms simply were never paid. They just never received the capital they needed to support their staffs. And sadly, many of them had to close. In effect, that's kind of it. I do want to, well, before we go to Q&A kind of verbally here, I do want to take one quick peek back at the Canadian dollar thing that we were running in the background here just to kind of see how we did. So 1, 2, 4, we'll go 6, 8, 6. Looks like kind of the final number there, close to it. It's been about an hour. So we're going to go with that. Voila, congratulations. We actually succeeded. We beat the odds. We generated a 0.32% return in 60 minutes. And using the power of compounding interest, at the end of one day, we'll have $107,000. At the end of 1 week, we'll have $170,000. At the end of the month, we'll be millionaires. We've done well. And Excel can't show you the number down in line 27 because it's so big, but it's, let's see, hundreds, thousands, millions, billions, trillions, whatever's above trillions, we made 153 of those, whatever that is. But this easily could have gone so horribly bad in so many different directions. And just to illustrate that for giggle's sake here, let's say we closed out at 1.45, we would have lost all of our money in a single day. And when you're in the business of planning a capital project, leverage matters a lot. And your clients who are highly leveraged will push you around in ways that clients that are not highly leveraged won't. And with that, the floor is open.
Great. Thanks, Russ. That was a great presentation.
For those of you who are AIA members, in the chat box, you can see the, you can receive a credit for this presentation by following the link and filling in the fields. And again, thank you so much to Russ Robertson. It was really outstanding presentation. And I think everybody's, it seems like that's a, everybody feels that way. So thanks again.
It's unanimous. We have any questions? Do you see any questions on your end, Basil? Or
no, just
it's just compliments.
Just of everybody. I think everybody found it as fascinating and informative as I did. And
well, it is such a complicated world out there, I think really is kind of the bottom line. You know, the simplicity with which your clients can operate is long gone. You know, those days are numbered, and we're entering into a whole new stratosphere here in terms of complexity. So I would just encourage each of you to be creative in how you think and how you operate. We're entering a new era.
This is a first.
Standing ovation, Russ.
You're speechless. There's nothing to it.
So it was a lot of information. It's gonna one of the things that I think just in this brief time that I took away is that I've recognized all of the different models at one point or another in my career. that's sort of like taking the curtain away and be able to see what's actually going on, which is very interesting and shedding a lot of light.
Good question from Cindy, a question about energy efficiency. And, Cindy, I think in some ways the answer is really pretty simple. It's dollars in, dollars out. What are you investing in the way of energy efficiency measures? What kind of subsidy can you use or attract to use those techniques? And then what do you gain in the way of long-term operational offsets, reduced energy costs, and all of those things kind of weave their way into all the math formulas that were on the table there. It's sort of a dirty little secret that solar really actually doesn't work a lot, in part because the subsidy needed to make it economically viable for most clients is there, but maybe not all the way there. And so, you see solar installations, for instance, and other really extreme energy efficiency used primarily in instances where the client is motivated more by the emotion of having it than the economics of having it. And it's not the right thing to do to be dismissive of that. The emotional connection to energy efficiency measures, even if they're not exactly the most economically advantageous, is very real. And that's, worth noting. Good question about asking owners to share project financials. Write it into your contract. It's that simple. We've seen contracts that write it in. By the end of schematic design, the client must present some evidence of financing. And same for builders. Builders can ask for the same thing and sometimes get it. I can tell you we've seen a number of instances where a builder will require that their client provide some evidence of financing at kickoff, at mobilization, just to demonstrate that they're covered. Ask for it. Don't know the Green New Deal. Be interested in hearing more about that, Jeremy. I don't recognize that one. If my email address is on the screen, maybe if you could shoot me a note about it, we can talk offline. I'd love to learn more about it.
There's a question about the insurance industry.
Yep. Yeah, looking at that one now, trying to expand my little screen here so I can read it. Insurance industry is looking closely at the impacts of climate crisis. Do you see a time coming when increases in insurance due to climate-related natural disasters will alter the way projects are financed? How do you see the climate crisis affecting everything you're presenting? It's so interesting because I guess there are really kind of two ways to think about climate crisis. One, particularly in coastal areas, Maryland, Florida, the places that we tend to work frequently, rising sea levels is kind of the number one perceived threat. But in reality, I think we all know there are more threats than just rising sea levels. Some insurers are in fact beginning to withdraw their interest in insuring properties in certain coastal flood zones. And the design configuration or alternate configuration, I guess I should say, really involves putting all sacrificial space that's not crucial on the ground floor and all essential space upstairs. So if you're inundated, life goes on, you sort of self-insure everything down below, and that's a risk that some developers we know are beginning to take. And then as it relates to other environmental disasters, concerns, storm frequencies, temperature changes, impacts on HVAC systems. Let's hone in on HVAC systems just for a moment. The HVAC industry was threatened by the introduction of green building. In 2000, right around 2000, when USGBC and LEED really became kind of the thing, the mechanical industry was scared to death. And the position that we had for Mechanical Contractors Association of Maryland, MCA of Maryland, was at that time was, don't worry, your job is actually about to get harder, not easier. You're not going to lose your stuff. Your stuff's going to become more advanced. It's going to become a lot more technologically sophisticated, and it will be able to respond more to changes in climate over time. The blue collar mentality of HVAC trades will need to become more like white collar, in the sense that the intellectual property that's required to manage complex mechanical systems will change and grow over time. And one last one, it looks like from Steve Ziegler, the key to reliability of the early cost estimates is setting up an economic model. Unfortunately, there's a lack of accountability holding to estimates even with no design changes or VE. So when the estimate is off, it drives havoc in the model. And Steve, you're absolutely right. I mean, this is the old garbage in, garbage out statement. If your fundamental financial model from day one is flawed, nothing else matters. And we as a company are often victimized by what I'm about to say next, but it's a very necessary evil. When you're in those early moments and all you have is a concept, you really have to layer on what seem like ridiculous contingencies, 20, 30, sometimes even 40%, when all you have is a narrative of what the project might be like, because there are just so many unknowns at that point. That, you know, there's sort of an inverted funnel. Very early budgeting includes massive contingencies. And as time goes on, we all know this, I think intuitively, the purpose of, well, I should say today's utilization of the SD, DD, CD funnel is to simultaneously incorporate input from general contractors who can help refine that understanding of pricing. And in a perfect world, you start out with wide open contingency around all the unknowns at the beginning. And as you move from stage gate to stage gate to stage gate, you pin down the uncertainties so that the variation around a final cost is minimized by the time you're ready to build. And one last question here from Jeremy. Do you see the moment to divest in fossil fuels taking off quickly enough to transition to renewable energy? Here's a really interesting speculation question for you. If you've ever taken a microeconomics class, you'll understand supply, demand. When there's not enough supply and a lot of demand, prices rise. On the flip side of that, if fossil fuel is being divested, demand falls. Even if there is supply, prices will fall. I suspect, but can't prove for at least another 30, maybe 50 years, that we're going to experience an adrenaline spike right before the fossil fuels. I think fossil fuels are going to be gradually underutilized over a long span of time, measured in 30, 40, 50 years perhaps. And then right at the end, it becomes obvious that we're not ready to make our permanent transition away from fossil fuels. The demand will spike because people will want their one last grab, and that's about it. And I suspect there will be a massive spike in pricing in oil and gas right at the very end of the use of fossil fuels. But I think it's going to take decades for that to play out. That would be my guess.
Thank you. Again, there's a link in the chat box for the AIA credits. If you click on the link, there'll be a few fields to fill in, including your AIA number to receive an AIA credit for this program. And thank you very much.
So much. It was a pleasure to speak with you.
We very much enjoyed having you. Thank you.
Be safe.
Bye-bye.